The New York Stock Exchange alone trades billions of stocks every day. You can buy stocks in over 43,000 companies around the world. So how do buyers choose which ones to buy? Before you can answer this question, you need to know what stocks are and why people and businesses invest in them. Stocks are small pieces of a company that you can own. So when people buy stocks, they get a piece of the company's income, which show how well or how poorly the company does. The price of a stock is based on how many people are buying and selling it. If there are more buyers than sellers, the price will go up. And if there are fewer buyers than sellers, the price will go down. So, the market price of a share shows how much people who want to buy or sell shares think the stock, and by extension, the company, is worth. This means that the price can change a lot depending on how buyers feel about the company's chances of becoming profitable, even if it isn't yet. People who invest want to make money by buying stocks that will go up in value over time. Some owners just want their money to grow faster than inflation, which makes their money worth less. Others want to beat the market, which means that they want their money to grow faster than the success of all stocks in all companies put together. The idea of beating the market is controversial among investors. In fact, investors are split into two main groups over it. Active investors think they can beat the market by picking the right stocks and trading at the right time. Passive investors, on the other hand, don't think it's usually possible to beat the market and don't believe in stock picking. Beating the market generally means getting a better return on an investment than the Standard & Poor's 500 index. The S&P 500 is a way to compare the average performance of 500 of the biggest companies in the US. It is weighted by the company's market values, so companies with higher market values have a bigger impact on the S&P. Remember that a company's market value is what investors think it is worth, not how much money it makes. The S&P doesn't directly show the market as a whole because many small and medium-sized stocks move in different ways. For now, it's a pretty good stand-in for the market as a whole. People often say, the stock market acts like a voting machine in the short term and a weighing machine in the long term. This means that changes in stock prices in the short term show what people think, but in the long term, they tend to show how much money companies are making. Short-term voting machine buyers try to make money in the market by being active. They think that the market isn't always efficient and that stock prices may overvalue some companies, undervalue others, or not reflect changes that will have an effect on the market at any given time. People who are active buyers try to take advantage of these flaws by buying stocks that they think are undervalued. They might look into how a company does business, look at its financial records, watch price trends, or use algorithms to find stocks that aren't worth as much as they should be. The long-term weighing machine part of the market is what passive buyers trust. They think that markets may be inefficient at times, but that those inefficiencies will be balanced out over time. This means that if they buy a variety of stocks that show different parts of the market will grow over time. Index funds, which are groups of stocks that represent the whole market, are often used to do this. The S&P 500 index is just one type of measure. All index funds want to do the same thing, which is to hold on to stocks for a long time and not worry about short-term changes in the market. In the end, active and passive investing aren't mutually exclusive. Many investment strategies have parts of both. For example, picking stocks actively, but hanging on to them for a long time, which is what passive investing suggests. Investing is not a precise science. If there was a way to do it that would always work, everyone would use it. And if you found value in today's video, don't forget to like, subscribe, and hit that notification bell, so you never miss out on the latest financial tips. Your financial empowerment starts now. Let's build a brighter, wealthier future together. Until next time, stay financially savvy.